You know, it's the oldest story in business, isn't it? You have this brilliant strategy, looks fantastic on paper,
Uh-huh.
and then, well, trying to make it actually happen. That's where things often, fall apart. Strategy execution is just tough.
It really is. We track so many things, launch initiatives,
Yeah.
but the results,
Mm,
sometimes they just don't match the plan.
exactly. And maybe, just maybe, the biggest mistake isn't getting the answers wrong, but asking the wrong questions in the first place.
I think that's spot on. It's easy to get completely lost in the day-to-day of execution, but the leaders who really succeed, at least based on the sources we looked at for this deep dive,
Yeah.
they seem to cut through all that complexity by coming back again and again to a few really fundamental questions. And these aren't just, nice ideas. The sources frame them as absolutely essential. Implementation imperatives, they call them.
Implementation imperatives. I like that. And that's really our mission today, isn't it? We've dug into these sources to unpack, what is it, 7 specific
Those, right?
questions?
7?
We want to understand why they're so important, how the successful companies actually use them day in, day out, and, well, what happens when you don't ask them?
Mm-hmm.
And this deep dive, it's really for you, the listener, to kind of get a quick handle on these vital concepts.
So the framework itself is built around these 7 questions. They come in a specific order, and the sources suggest you can even remember them using something like the 7 C's, just different aspects you need clarity on.
Right, 7 C's. And there's a logic to the order, too. The first couple, they're like the foundation, right? Setting the stage.
Exactly. Q1 and Q2 are foundational. Then Q3 and Q4 are about getting focus.
Okay. Focus. Makes
And
sense.
then the next pair, 5 and 6, they're about facilitating the right kind of behaviors you need.
Right. Getting people to act in line with the strategy.
And the last one, number 7, that's about looking ahead, staying adaptable, the future.
And these aren't just like a checklist you tick off once. The sources are clear. They're non-negotiable imperatives. Crucial for success, crucial for avoiding, well, big risks.
Absolutely. Okay, so let's dive into the first one. It might sound almost too basic, but the sources argue this is possibly the single most critical strategic choice a company makes.
Okay, what is it?
Who is your primary customer?
Ah, simple, but I can see how that could be tricky. Why is that the most critical?
Well, the sources make a really strong case. If you get this right, if you have absolute clarity,
Uh-huh.
it lets you channel, well, basically all your resources towards meeting their specific needs. And just as importantly, you can consciously decide not to spend resources on everything else.
Okay, so it's about focus. Extreme focus.
Exactly. That single-minded dedication, that's what drives competitive advantage. Because the flip side,
The pitfall.
right, trying to serve more than one primary customer, the sources basically say it's a guaranteed recipe for underperformance. A competitor focused on just one will always beat you there.
Because their resources aren't spread thin.
Precisely. And it also means being really disciplined about who is not your primary customer, even if they, use your product or pay for it sometimes.
Can you give an example?
Think about Mary Kay Cosmetics. And consumers buy the makeup, obviously.
Right.
But Mary Kay's primary customer, it's the independent beauty consultant. That's who they pour resources into: training, support, motivation, because the consultants drive the sales.
Ah, interesting distinction. So the user isn't always the primary customer.
Not always. And this idea can even cause trouble internally. The sources mentioned Harvard telling students they were customers.
Oh, I bet that led to some interesting demands.
You bet. And Medtronic's former CEO realized calling internal departments customers was muddying the waters, pulling focus from the real external customer. He actually stopped using the term internally.
Wow. Okay. So what happens when you have competing interests, like different groups wanting different things?
The sources point to leaders like Jeff Bezos at Amazon. When faced with a tough call, his go-to question was always, what's better for the consumer?
Even if it upset other players, like the third-party sellers.
Especially then. He held that line. And the result, Amazon ended up with, apparently, the highest customer loyalty for a U.S. retailer. That relentless focus paid off.
So it's not enough just to name the primary customer?
Not at all. You have to deeply understand what they truly value. Procter & Gamble, for instance, built their whole culture around the consumer as boss.
I've heard that.
They even had this Living It program where executives would literally go live with consumers for a bit.
Seriously. Live with them.
Yep, to get real firsthand insight. And it's not just P&G. Disney, Continental, Cisco, Amazon, again, they all put execs into frontline jobs.
Just to see what customers experience and value.
Exactly. And this is crucial globally, too. L'Oreal and Estee Lauder researching beauty needs in China, even changing shampoo formulas because of the local water supply. That's deep understanding.
It's not just consumer stuff either, right?
No, definitely not. Lou Gerstner at IBM made his execs visit key business customers, really analyze their operations, and then recommend IBM solutions tailored to what that customer valued.
Okay. And FedEx. Who's their primary customer? The person getting the package.
Actually, they identified the sender as primary because the sender is the one choosing FedEx, paying the bill, trusting them with the delivery.
Makes sense. So the core idea is simple, but probably hard to execute. Pour resources into that primary customer, minimize everything else.
Simple concept, profound implications. It forces really tough choices. Look at a McDonald's. For years, they seemed split between franchisees and real estate developers.
Because of their model, yeah.
Right. Resources were centralized. But then consumer tastes started changing regionally, and that structure couldn't keep up. They had to reorganize, put resources out to focus on those regional demands.
And Pepsi had a similar challenge. Consumers versus retailers.
Exactly. Consumers want innovation, variety. Retailers, like the bottlers, value efficiency, consistent supply, good margins. Those needs conflict.
So what did they do?
They actually split the company in 1999. PepsiCo focused on the consumer, and a separate bottling group focused entirely on the retailers, allowed each to optimize for their primary customer.
Wow, that's a big move.
It is. Cisco did something similar after a bunch of acquisitions left them kind of scattered. They refocused on their channel partners, the resellers who drove most sales.
And that meant changing how they were organized.
Big time. They had to restructure, decentralize operations, deliver the low costs and cutting-edge tech those partners valued most.
And you see this with financial firms, too, like JP Morgan Chase.
Yep, Jamie Dimon came in, consolidated systems, cut support jobs that weren't customer-facing.
To free up money?
To hire thousands more salespeople to serve customers directly. Henkel, the German company, even adopted a just good enough standard for internal staff groups.
Just good enough.
Meaning don't overspend internally, focus resources on the primary external customer.
So the follow-up question here isn't just who is the primary customer.
Right. It's, does everyone in the organization, top to bottom, really know what that primary customer values? You have to keep reinforcing it.
And what about huge companies like GE that genuinely serve totally different types of customers?
The common solution there is separate divisions. Let each business unit organize itself around its own specific primary customer: energy, aviation, healthcare, whatever it is.
Okay, that makes sense. That clarity is foundational, which leads us, I guess, to the second question.
Exactly. Still foundational, but this one's about navigating complexity and guiding tough decisions. How do your core values prioritize shareholders, employees, and customers?
Ah, the values question. This feels critical, especially when things get tough.
Absolutely. Because managers, especially in decentralized companies, are constantly facing trade-offs. Do we chase the quarterly profit target, or do we invest in quality for the customer? Do we protect margins for shareholders, or do we protect jobs during a downturn?
And values are supposed to be the guidepost.
That's the idea. When those interests clash, shareholders versus employees versus customers, people need to know which way the company expects them to lean.
The Merck Vioxx story comes to mind here. That must have been an agonizing decision.
A prime example from the sources. Data shows heart risks. What do? Keep studying. Put a huge warning label on it. Or pull it completely, costing billions.
And their values guided that decision. Towards patient safety, presumably.
The context strongly implies that patient safety, a core value, was paramount, leading to the withdrawal despite the immense financial hit.
Most companies have those value statements, right? Integrity, teamwork, diversity. You see them on the walls.
Sure, they list admirable traits. But the real test, the sources say, is how those values help you prioritize between shareholders, employees, and customers when their needs conflict.
So different companies prioritize differently.
Definitely. Some genuinely put employees first. Southwest Airlines is the classic case. Their no layoff policy is famous.
And they've been incredibly successful financially, too.
Exactly. The sources suggest that focus on employees has driven their success, not hindered it. HCL Industries in India is another example, really focused on employee engagement. Managers even accountable to their subordinates.
But the real test is when times get tough, right?
That's what the sources emphasize. Are you willing to take a profit hit to avoid layoffs, like Southwest did in 2009, or like Nucor, the steel company? That shows true commitment to employees first.
Okay, what about the other end, shareholders first?
Well, historically, groups like the Business Roundtable explicitly stated management's top duty was maximizing long-term shareholder value.
But that view has critics now.
Oh, yeah. Even Jack Welch, who pushed it hard at GE, later called it the dumbest idea in the world.
Really? Welch said that.
Yep. He argued shareholder value is a result you get from focusing on customers, employees, products. It's not the strategy itself, and the risk of putting shareholders above all else.
Short-term thinking.
Exactly. Short-term focus, maybe cutting corners, and ends justify the means mentality. The sources mentioned AIG using stock grants that incentivized risky short-term plays.
But shareholder focus isn't always bad, is it? What about the Pfizer example with Celebrex?
Right. They added a strong warning label. Yes, it likely impacted sales, maybe hurting short-term shareholder value, but it prioritized informing patients about risks. So it's often a balance, even within that framework.
And some companies try to explicitly balance all three.
Yes, IBM CEO Sam Palmisano talked about core values providing that balance, client success first, but considering shareholders and employees too.
So how do you make values actually real, not just posters on the wall?
Two main ways stand out in the sources. First, the really tough decisions. Those become company legends. J&J and the Tylenol recall is the classic. Pulling every bottle showed managers definitively that customer safety trumped short-term profits.
That story still gets told decades later.
Because it was real. The second way is through promotions and rewards. This is where the rubber meets the road.
Who gets ahead?
Exactly. You can talk values all day, but if you promote people who behave badly, who cut corners, who undermine colleagues, you create massive cynicism. Every promotion sends a signal about what's really valued.
So the follow-up questions here are pretty sharp.
They have to be. Can you point to actual tough decisions guided by your values? Do managers have those stories? And is everyone really committed to living them?
Okay. So we've got the foundation, primary customer, prioritized values. Now we move to focus. Question 3.
Right. Getting everyone focused on the job at hand, on the strategic priorities. Question 3 is, what critical performance variables are you tracking?
Metrics, KPIs, scorecards. This is where strategy meets measurement.
Exactly. Setting the right goals, assigning accountability, monitoring how things are going. But the danger, as we know, is focusing on the wrong things or just drowning in data, information overload.
There was a Citibank example in the
Yeah,
sources.
a really good one. This manager, James McGarren, was blowing away his financial targets, revenue, margin, way up. Fantastic numbers.
That was great. What's the problem?
His customer satisfaction scores on a new company scorecard were really low. So the dilemma for his boss, Lisa Johnson, was huge. Reward the stellar financials or penalize him for the low scores.
It shows the limits of just looking at the financial numbers.
Totally. Like GM booking revenue when cars shipped, even if they pile up unsold on dealer lots because customers didn't want them. The financials looked okay for a while, but hit a massive underlying problem.
So how do you identify the right variables? The ones that really matter?
The key, according to the sources, is you have to be able to explain your theory of value creation. How does your business actually work? How do you succeed and make money? Only then can you figure out which metrics are truly critical drivers.
Not just a random list of KPIs from a textbook.
Definitely not. You need to show how the variables fit together, how they tell the story of your strategy working or not working. A random list doesn't build confidence.
The sources mentioned a technique for finding these. Something about inverting.
Yeah, borrowing from Warren Buffett. Invert, always invert. Instead of planning for success, imagine total failure 5 or 7 years out.
Yeah.
Your strategy collapsed. Why? What killed you?
Okay, so you work backward from disaster.
Right. Did you lose your tech edge? Did your best people leave? Did a key supplier fail? Did quality tank? Thinking about the potential causes of failure helps you pinpoint the variables that are absolutely critical. Failure on those means the whole strategy fails.
So a follow-up question for leaders is, what could genuinely cause our strategy to fail?
Exactly. Is it tech, supply chain, quality, key relationships, talent? For that Citibank relationship banking strategy, the invert exercise probably points to customer loyalty being way more critical than just satisfaction on a single transaction.
And the sources suggest there aren't that many truly critical measures.
Typically only a handful, maybe 5 to 8, even in complex businesses. For Amazon, focused on convenience, maybe it's revenue per click. For Citibank, loyalty, market share, revenue from target customers. Marriott tracks things like employee satisfaction, guest satisfaction, revenue, and RevPA.
RevPA, revenue per available room, key hotel metric.
Right. And sometimes finding the right critical measure takes real insight. Nordstrom focused on high service.
Yeah. What do they track?
Sales per hour for their associates. Seems small, but it directly measures the productivity of their high service model.
Interesting. Now, these non-financial measures are crucial, but what about the money?
Oh, financial measures are always critical. The sources talk about profit wheels, different levels of tracking. Minimum is basic P&L. Revenue, expense, net income, assets.
Okay, standard stuff.
Better is adding working capital measures, receivables, cash, inventory. Managing those well frees up capital.
Right. Cash is king.
And the best level adds ROCE measures, return on capital employed. Looking at returns on assets, making sure everything is working efficiently.
Even Apple, known for innovation, is obsessed with financials.
Maniacally focused. Inventory turns, cash flow, balance sheet. Tim Cook calling inventory fundamentally evil. They manage it incredibly tightly.
And weak financial controls are a huge red flag.
Massive. The sources mention AIG systems being so bad, execs felt they couldn't even kick the tires. Solid financial systems are just table stakes.
Okay, so you identify the critical variables, financial and non-financial. Then what?
Then you have to connect them. Link them directly to goal setting, accountability, and crucially consequences. Rewards and, well, lack of rewards. They have to mean something.
So it's not just tracking, it's driving action.
Exactly.
Mm.
Contrast GM under Rick Wagoner, seen as maybe too forgiving despite huge losses, with Jamie Dimon at JP Morgan Chase, who demands strict accountability, ranks managers, ties bonuses tightly to those metrics.
And accountability isn't just about money, is it?
No. The leader's own attention is incredibly powerful. A.G. Lafley at P&G tracked missed shipments weekly, demanding action plans until performance improved. Frank Blake at Home Depot cut down those massive scorecards to just 8 critical measures and held people accountable for those.
Okay, so question 3 is about sharp focus through the right metrics and clear accountability.
You got it. Which sets up question 4 nicely, because it's also about focus, but from the other side.
The other side.
Telling people what not to do. Question 4. What strategic boundaries have you set?
Boundaries, like guardrails for the strategy.
Exactly. They protect your reputation, prevent wasted effort on things that are off strategy, stop that undisciplined growth that can kill companies. They draw clear lines.
The American Cancer Society example was interesting here. They wanted to advocate for access to care.
Right, which could get political very quickly and risk alienating donors.
So they set clear boundaries.
Explicit do-nots.
Right.
We will not be partisan, not endorse candidates, not give political money, not form a PAC. Simple, clear lines that protected their mission and allowed them to advocate effectively.
Most companies have codes of conduct, but these boundaries are different.
The sources argue they need to be much clearer and more concise than dense legal documents. Think thou shall nots. Specific, unacceptable behaviors or strategic directions, like the 10 Commandments, short and unambiguous.
And these often relate to reputation risks.
Hugely. Your industry, your strategy dictates the risks. Toyota pushing for growth arguably breached implicit quality boundaries, leading to recalls that hammered their reputation.
Right, or the fertility clinic example, Sydney IVF.
Yeah, setting boundaries around anonymous donations or embryo donations to maintain trust with their specific patient group who valued knowing genetic lineage.
Boundaries also stop companies chasing every shiny object.
Yeah, definitely.
Yeah.
Undisciplined growth. Howard Schultz saying Starbucks expanded too fast into dreary strip malls without the discipline to say no. Boundaries tell managers upfront what kinds of initiatives are off limits, saving time and focusing energy.
Saying no is hard, though, especially if something looks profitable but doesn't quite fit.
Very hard. There's pressure to bend or erase boundaries. The energy company AES removed a limit on investment size per market.
And that ended badly.
Huge losses later when opportunities exploded and they overextended. The founder called removing the boundary an act of arrogance.
It's interesting, even creative places like Google need boundaries. They're 20% time.
Even there, it's not a total free-for-all. Projects have to meet certain criteria: customer interest, attracting colleagues, solving big problems, hitting performance targets. Those boundaries channel creativity towards things more likely to succeed.
So the follow-up questions for boundaries are about identifying risks and drawing clear lines.
Yeah. What are your major reputation risks? Does everyone know what's truly off limits? What strategic areas will you simply not pursue, even if tempting?
Okay. So tracking variables tells us where to go. Boundaries tell us where not to go. Now we shift to behaviors. Question 5.
Exactly. Facilitating the right behaviors. Question 5. How are you generating creative tension?
Creative tension sounds stimulating, maybe stressful.
Both, potentially. It's about pushing people beyond their comfort zones, sparking innovation, encouraging different ways of thinking, preventing complacency.
How do companies do that?
One way is motivating people like winning competitors. Using stretch goals, Toyota aiming for near-impossible targets pushed innovation, unlike GM's complacency, which led to bankruptcy.
Right.
Or ranking individuals or groups, a Silicon Valley tech firm, or the American Cancer Society ranking its regions. Seeing others excel on key metrics creates tension and encourages adopting best practices.
And breaking down silos between departments. That ITT example.
Yeah, Harold Gene worried about VPs only thinking about their own box.
Hmm.
You need mechanisms to force cross-unit thinking.
The sources had a surprising idea here. Accountability greater than control.
Counterintuitive, right. Traditional management says authority must equal responsibility. But the sources argue that can stifle collaboration.
How so?
If you control everything you need, you don't have to collaborate. But look at Siebel Systems. Managers were accountable for overall customer satisfaction, broad accountability.
Okay.
But they didn't directly control all the resources needed, narrower control. This forced them to build relationships, negotiate, innovate across units to get things done for the customer. That gap creates tension that drives collaboration.
Interesting. What else creates that cross-unit tension?
Allocating costs, making managers pay for services or overhead from other units. Suddenly, they care a lot about how efficient those other units are.
Like Jamie Dimon making business units pay full freight for corporate overhead.
Exactly. Or Percy Barnevik at ABB, allocating all corporate costs, cost of capital, even replacement cost appreciation. It makes managers scrutinize spending everywhere.
Cross-functional teams seem like another obvious one.
Yep. Task forces, project teams, they pull people out of routines, expose them to new perspectives, spark ideas, help share innovations. Gene at ITT use them constantly.
And matrix structures, reporting to multiple bosses.
That's kind of the extreme version. Region boss, product boss.
Yeah.
Forces balancing conflicting priorities. Can spur innovation by bringing diverse views together, like at HB under Fiorina or P&G in the 90s.
But matrices can get messy, right? Slow things down.
Big-time pitfall. Too many cooks, too many vetoes. Cisco's complex committee structure under John Chambers apparently slowed decisions way down, helping competitors. P&G eventually abandoned this matrix because it hampered performance.
So it's a balancing act.
Definitely. The follow-up questions are key. How are you really pushing people to think like winners? How are you genuinely encouraging cross-unit innovation? And, critically, have your structures become too complex, actually hindering progress?
That complexity point leads nicely into the next question, number 6, which also seems focused on how people work together.
It is, and it's a fundamental choice for leaders. How committed are your employees to helping each other?
Helping each other versus what? Looking out for number 1.
Pretty much. Self-interest versus commitment to the team, to colleagues. The sources argue this is a core leadership decision, and getting it right unleashes huge power. Getting it wrong, well, your strategy can just fall apart.
The comparison in the sources was really stark here. Southwest versus Enron.
Incredibly powerful contrast. At Southwest, you hear stories of pilots helping load bags to hit that crucial 10-minute turnaround. Gate agents, flight crews, ground crews, all pitching in, knowing success depends on everyone helping.
A real team ethic.
Totally. Then you look at Enron. The culture described was mercenary, selfish, eat what you kill. Constant jockeying for individual bonuses.
Resenting colleagues' success, even sabotage. Locking computer screens.
Exactly. A culture where people actively worked against each other for personal gain. It's the polar opposite of Southwest.
So leaders have to choose which model fits their strategy.
Yes. And self-interest can be the right model for certain businesses. Maybe a boutique investment bank focused on individual rainmakers, or certain trading desks, some call centers, where individual contribution is easily measured and teamwork isn't the primary driver.
But there's a big warning label on that approach.
Huge warning. If you foster self-interest, your core values and strategic boundaries have to be rock solid. You need clear rules about minimum do-no-harm behavior and absolute clarity on what gets you fired instantly. Otherwise, you risk becoming another Enron.
And for most companies, especially complex ones or those built on relationships.
You absolutely need that commitment to helping each other. Southwest couldn't operate without it. Complex tech, deep customer service, it relies on teamwork.
So how do you balance? You might use competition like rankings from question 5, but you also need collaboration.
It's about competing and collaborating. Compete against yourself, maybe against peers on certain metrics, but always be ready to help a colleague when asked. compete alongside each other as a team against the external competition.
This requires leaders to really understand motivation, doesn't it? Like psychologists, almost.
That's what Ken Iverson at Nucor suggested. You have to understand what makes people tick and avoid that trap of rewarding behavior A while hoping for behavior B.
Rewarding A while hoping for B, the motivation pathology.
Right. A pure self-interest theory X approach is simple stimulus response. Tie money directly to individual results. Commissions, bonuses by formula.
Right.
Enron's Ken Lay explicitly praised individualized compensation, big payouts.
But building that commitment to helping requires something different, like the military model.
That's the comparison the sources make. Think U.S. Marine Corps. They invest heavily in building psychological bonds because in combat, you must trust your buddies have your back.
So what are the ingredients for that kind of commitment in business?
4 key things: pride and purpose, identification with the group, trust, and fairness.
Okay, break those down. Pride and purpose.
Feeling proud of the company's mission, feeling like you're part of something important, making a difference. Southwest's giving America freedom to fly. Merck putting patients first. Amazon being customer-centric. ACS eliminating cancer. That shared purpose motivates.
Identification with the group, feeling like part of a team.
Exactly. That sense of belonging fostered through shared experiences, maybe rituals. Southwest talks about a warrior spirit.
Trust seems obviously critical.
Maybe the most important. Believing others will help you when things get tough. Nucor's success was built on trust, pushing power down to the front line, creating owner-operators.
And fairness. Believing the system is just.
Crucial. Believing rewards are distributed fairly. Nucor, despite being non-union, achieved incredible results, partly because of that perceived fairness in their flat structure and how gains were shared.
So the follow-up question for leaders here is about actively building that shared responsibility.
Right. How are you creating it? And what's standing in the way? What's undermining trust or fairness?
Compensation must play a huge role here, too.
Massive. You need to balance individual and team rewards, but huge pay disparities. They can be toxic.
Like the Daimler-Chrysler example. Pay gaps fueling resentment.
Exactly. It killed collaboration between the German and U.S. sides. Or the Enron trader furious about only getting $500 when others got more. That stuff destroys willingness to help.
So fair sharing is key. Southwest execs taking proportional pay cuts.
Yeah, that sends a powerful message of shared fate. It builds trust. It's different from just forcing execs to hold stock so they go down with the ship. The Southwest way builds commitment while still allowing flexibility.
Okay, wow. That's a deep dive into culture and behavior. Which brings us to the final question, number 7, looking ahead.
Yep, this one's about survival, adaptation, staying relevant. Question 7, what strategic uncertainties keep you awake at night?
Because most companies don't adapt successfully over the long run.
Sadly, no. Look at the churn in the Dow Jones Index. Giants vanish. Bethlehem Steel, Kodak, Sears, Woolworth. Companies tend to cling to the past, to what made them successful before. You have to actively fight that inertia.
And failure often comes from missing big shifts.
Absolutely. The sources mention a J&J competitor missing a new tech from an adjacent field. AOL assuming broadband adoption would be slow, completely missing the boat as Google, Facebook, YouTube took over.
The 2008 financial crisis, too? The signals were there?
Signals existed, but most firms didn't focus attention on the underlying uncertainties about the housing market and complex derivatives, unlike Goldman Sachs or JP Morgan Chase, who saw the risks earlier.
So strategic uncertainties. These are potential changes that could just blow up your whole strategy.
Exactly. They're different for every business. Microsoft worrying about the internet versus software. Google and regulation. Newspapers and delivery tech. Retailers and shopping patterns. Pharma and patent cliffs.
The challenge isn't just knowing they exist, it's getting the organization to pay attention.
That's the core problem. And how do you signal what's important? Simple truth. Everyone watches the boss.
What interests my boss fascinates me.
You got it. So you as a leader have to visibly, consistently focus on these uncertainties yourself. Your questions, your time allocation that signals priority.
How do you make that systematic? The sources talked about using systems interactively.
Right. Taking a regular management system like budgeting or planning and using it not just for control, but to spark dialogue, learning, and adaptation from the bottom up. J&J's profit planning is a classic example.
They reforecast constantly.
Quarterly, annually, always looking out several years, revisiting the same future years again and again.
And asking key questions.
3 crucial ones. What has changed? Why? And the killer question, what are you going to do about it? The third question forces action plans. Gene at ITT used his famous marathon meetings interactively like this too.
Goldman Sachs used their P&L system that way during the crisis.
Exactly. Daily P&L checks against risk models. When losses spiked in mortgages for 10 straight days in late 2007, the top brass immediately met, asked, what has changed? Why? The answer, our core assumption is wrong. Then, critically, what are we going to do about it? That led to de-risking and hedging while competitors were still in denial.
So other companies use different systems interactively. Brand revenues, project management, intel systems.
Yeah, Pepsi and Coke track brand data interactively to react fast.
Yeah.
Low-cost firms track tech and competitors' products. Pharma tracks socio-political trends. The specific system matters less than the interactive process of questioning and dialogue.
And it relies on getting information flowing up from the front lines.
Absolutely. Top-down questioning stimulates bottom-up information flow. People closest to customers, tech, markets, they see the changes first.
But getting them to speak up is hard. People are busy, maybe afraid.
Both.
Mm.
People won't naturally share info outside their routine unless asked. And fear is huge. Fear of looking stupid, fear of challenging the boss, fear of being the messenger with bad news.
The Lehman Brothers trader example. Saw the problems but was afraid to rock the boat.
Exactly. Or Intel's Andy Grove worrying about people being afraid to tell him bad news. You have to reward courage.
Like Alan Mulally at Ford applauding the executive who finally showed a red status report.
Precisely. He changed the culture from hiding problems to surfacing them by rewarding honesty, even when the news was bad. You have to encourage challenging assumptions.
Because failed companies usually operate on false assumptions.
Almost always. Housing prices only go up. Diversification eliminates risk. Digital migration will be slow. Customers won't trade features for price. You need a culture where those assumptions can be questioned.
And rewards should reflect that, not just hitting short-term numbers.
Right. J&J's Ralph Larson used subjective rewards to value participation in the interactive process, asking tough questions, contributing to the long term, not just hitting formulaic financial goals. It encouraged the right kind of thinking.
So the keys to making interactive systems work are involving managers, fostering real debate, and always asking.
What are you to do about it? That forces accountability for adapting to change.
Okay. That brings us full circle through the 7 questions. It's quite a framework.
It really is. From clarifying who you serve and what you stand for, to focusing effort and shaping behavior, all the way to staying vigilant about the future.
It really underscores the power of asking the right questions, doesn't it? These 7 implementation imperatives, as the sources call them.
Absolutely. It's about cutting through the noise and focusing on what truly matters for making strategy happen.
So a final thought for you, our listener, to maybe chew on after this deep dive.
Yeah.
Given these 7 questions, where is your own organization perhaps most vulnerable right now? Which of these questions needs the most attention, the most honest debate? Or maybe, what's one core assumption in your business that might be overdue for a serious challenge?
That's a great takeaway, something for you to really consider.
Indeed. Well, thank you for joining us on this deep dive into the 7 essential strategy questions. Keep asking those critical questions.